Schamotta is chief market strategist at Corpay. Nice to see you.
You as well.
This is why they pay you the big bucks.
Indeed.
I'm not sure in what currency.
In yen, of course.
Okay, first of all, what happened?
Right. So this is sort of the interesting part. We had, of course, this Bank of Japan decision last week to raise interest rates. That is being sort of pointed to as the proximate trigger for the turmoil that happened over the last week.
And was it a surprise?
It was, no, not exactly.
Okay.
I think markets had expected rates to rise for a bit. And in fact, on the day of the announcement itself, of the decision itself, the Japanese yen actually rose, or like kind of flatlined. It didn't move as dramatically as you would have a thought if it had been a huge surprise.
Right.
But what really was happening here was that the Bank of Japan is raising rates against an environment in which we're priced for perfection across a range of asset classes, right? The big deal here is that the U.S. economy has been outperforming the rest of the world for a very long time. Markets were anticipating a soft landing. Interest rate markets were set up in such a way. And so all of a sudden, we have the Bank of Japan raise rates, and then on Friday we get a relatively negative non-farm payrolls report. And what this does is it motivates a lot of market participants very, very quickly to establish hedges against a hard landing in the U.S. economy and a unwind in global markets. And so we saw equity markets come down, especially the U.S. Magnificent Seven tech companies. We saw that happen at the same time that people moved to the exits. And so it's like a situation in which, you know, somebody yells fire in a crowded theater, right? There were too many people in the theater in the first place, and when someone, you know, started to get concerned about the smell of smoke, all of a sudden everybody went out that exit at the same time, and the carry trade really sort of exacerbated the effects of that.
And the carry trade, again, these are when you're borrowing in one currency, which you expect to be weaker against another currency, and you're hoping to make money essentially on the spread there?
Yeah, so the big difference, or the typical carry trade, is where we borrow in a jurisdiction with a very low interest rate. We take the money out of that jurisdiction, we move it to another currency or in another place where interest rates are higher. So, for example, Mexico has been the most popular target in recent years. We wait, say, 3 months. We earn the interest that is being accrued in Mexico, and we repay the loan in Japan. Now, the problem with this, of course, is that there are essentially two exposures. Interest rates could move in an unpredictable way. So if Japan raises rates or Mexico lowers rates, the difference between the two would narrow, and then we're not making as much. But the biggest risk by far is the risk of an exchange rate move, right? So if the peso falls in value and the yen rises in value, our loan that we're repaying in Japan suddenly becomes materially more expensive. And so historically, this has led to a pattern that we've seen sort of over and over and over. Some people call it taking the stairs up and the elevator down. The more commonly known phrase is that we're picking up nickels in front of a steamroller. Whenever we're entering into carry trades, there is the risk that at some point we have a very, very dramatic series of events that culminates in a huge loss.
That's helpful. And how crowded was this trade, and who was in this trade? Is this something where like retail investors were even learning about it?
Yeah, so there's an old saying in Japan that Mrs. Watanabe gets into this. So this was the mythical sort of Japanese housewife who was borrowing in Japan and moving money into higher yielding locations elsewhere. We have businesses doing this. We have financial institutions doing this. We have even big institutional investors that are allocating funds outside of Japan. They're all engaged in this. And so this is why it's very, very difficult to measure quite how big it is, because a lot of this is conducted in the foreign exchange markets, which are fundamentally what we call over-the-counter markets. They're not listed. There's no like data that we can all look at that tells us how big it is. But the reality here as well is that it's an ecosystem, right? We have some players in this trade that can withstand losses, that can, you know, kind of ride this out for a long period of time. And then we have others that are using several hundred times leverage on their trades, right? And so when we have a move like we had on Friday and on Monday, in which the yen suddenly started moving up very dramatically and the peso was moving down and global interest rates were shifting, those very highly leveraged players, especially the retail investors, are forced to make margin calls and to close out their positions. And when they're doing that, it's very literally catching a falling knife. It's a situation in which you know, we have that very nasty sort of cascading effect across the financial system.
Okay, so speaking of the financial system, there were immediate worries about what they call systemic risk.
Yes.
Right? You never know where it's going to come from because there's all these mechanisms in the market, but everybody was fearful of that. You were
Right.
pretty quick to, I think, in your commentary, I was looking on what Bloomberg was picking up, suggest that the most dangerous positions in this trade would be closed out relatively swiftly.
Exactly, yes.
So are you still seeing or anticipating that to be the case, that the biggest concerns from this are starting to fade?
Yes, I think we were already seeing a big recovery. If you look at your broader measures of volatility, of expected volatility in the markets, they've come down dramatically. The VIX was like at 65 briefly on Monday, and now we're down to like 25. The reality is that the most exposed players in this market have been essentially knocked off. Their losses have been realized. Now, historically, what we do tend to see after an event like this is sort of after effects, like after tremors, in which we do have occasional freakouts going forward. But the systemic effects of this don't look all that material.
Okay.
What's interesting about this is that, on Monday, when there was a lot of panic about this, the assumption in markets was that this was going to force the Federal Reserve to dramatically reassess its policy trajectory. And it does not look as if that's happening. We're not seeing a global credit shock sort of unfold from this. We're not seeing a massive tightening in financial conditions. Those are the things that might motivate the Fed to deliver an intermeeting cut or to, go extra jumbo-sized in September. Some people were on Bloomberg, I think, actually talking about, a 75 basis point cut in September.
Oh, yeah.
That does not look likely at this point.
Well, and I was talking to the longtime economics correspondent Mike McKee for Bloomberg yesterday,
Yes.
who said the irony is if the Fed were actually to cave to those market pressures and to cut rates, that would further complicate this currency carry
Exactly.
trade that we're talking about.
It would also be like a panic signal, right? We know that the Fed, at least under current leadership, is not motivated to freak markets out to that extent and to scare the real economy by sort of sending up the flare.
What do you make of this Bank of Japan commentary today? Does this introduce a new part of central banks being more keenly aware that their words are going to matter in a jittery market?
I think that they do know this. This is one member of the committee that sets policy in Japan, saying that he does not think that we're going to continue to tighten at the pace that they have. That does introduce some two-way risk, I think. It does suggest that market expectations for consecutive hikes here over the next couple of years might be a little overwrought. I don't think it dramatically changes the dynamics here, but the key thing to break all this down to is that Japan now has a 0.25% interest rate, right? Mexico, for example, is at 10.5%. Right, the mechanics and the economics that underlie the carry trade still remain fundamentally intact. Now, obviously, we're going to have a lot of players who have been scared to the sidelines, but there are a large number of players who are going to go right back to doing the same thing because they know that even if Japan delivers multiple hikes over the next year and a half, that difference between Japanese rates and Mexican rates is still so wide that it makes sense to engage in the trade again.
Okay, and then if you were just going to the bank to get some different currency and you're wondering if this is a wild time in the currency markets for Canada, and the Bank of Canada is already cutting interest rates right now, and we've seen a weaker loonie versus the U.S. dollar. Is there anything to be watching for?
I think the big thing here is that we are seeing the Canadian dollar rally a bit on the back of this. And this is something that you and I have been discussing for probably the last 6 months, that at some point when the U.S. economy started losing momentum, that we'd see the Canadian dollar begin to outperform a bit. That is what we're beginning to see. So I think CAD is actually going to gain a bit from where we are. However, as we go into the autumn and later autumn, we know that there's a bunch of potential volatility catalysts that could shock the global financial markets and that could ultimately deliver a shock to the Canadian dollar. And so I think what we really should be taking out of this episode over the last week and a half is that markets have become too calm. They've become too complacent about the risks that are being faced out there. We're taking on too much leverage, and that some of that needs to come back and sit on the sidelines. We need to be more cautious given the number of macro uncertainties facing the world economy right now.
Okay.